It's February 11th, 2026, and silver is trading at $82.50 per ounce. But here's what should genuinely get your attention. The COMEX exchange currently holds 103 million ounces of deliverable silver in registered inventory. The March futures contract, which begins delivery in just 16 days on February 27th, represents 429 million ounces of potential delivery demand. Let me say that again so it sinks in. 103 million ounces available. 429 million ounces potentially demanded. Now here's where this gets interesting. 2 weeks ago, silver hit an all-time high of $121 per ounce. Within 48 hours, it crashed 33% to $76. The mainstream explanation? Margin calls, leverage unwinding, Kevin Warsh's Fed nomination. All true, but incomplete. Because while silver crashed on paper, something completely different happened in the physical market. In January alone, a traditionally quiet month for deliveries, COMEX processed 49.4 million ounces of physical delivery demand. That's roughly 7 times the historical January average. If you're holding physical silver and feeling confused, stop. If you're considering buying and feeling scared of another crash, pay attention. Because by the end of this video, you will understand exactly what's happening in the silver market, why the March delivery period matters, and what the actual math tells us about where this is heading. Let's get into it. Before we dive in, if you're new here, this channel focuses on silver and precious metals markets using real data, not hype. Hit subscribe and the notification bell so you don't miss updates as this situation develops. And drop a comment below. I want to know, are you holding, buying, or staying on the sidelines right now? All right, let's break down what's actually happening. To understand why March 27th matters, you first need to understand how COMEX actually works. And I'm going to explain this in plain English because most coverage gets this wrong. COMEX operates with 2 types of silver inventory. Eligible silver meets all the exchange standards, correct weight, purity, bar specifications. It sits in approved warehouses. But the owner has not made it available for delivery against futures contracts. Think of it as silver that's parked in a COMEX vault but has a not for sale sign on it. Registered silver has gone one step further. The owner has issued a warrant, essentially a delivery certificate, making it available to fulfill futures contract deliveries. This is the deliverable supply. As of February 11th, 2026, according to CME Group's daily warehouse reports, total COMEX silver inventory is approximately 403 to 411 million ounces. Registered, deliverable silver is approximately 103 to 113 million ounces. So only about 25 to 27% of the total inventory is actually available for delivery. Now, here's the critical context. In October 2025, registered silver stood at 167 million ounces. By early February 2026, it's down to 103 to 113 million ounces. That's a 38% decline in just 4 months, and the drain is accelerating. Current data shows approximately 785,000 ounces leaving registered inventory per day. Why does this matter for March? Because March is what's called a major delivery month on COMEX. It's one of the primary months when futures contracts can be settled with physical metal. The contract symbol is SIH26, March 2026 silver. According to exchange data, the March contract currently has open interest representing approximately 85,000 to 91,000 contracts. Each contract is 5,000 ounces. Do the math. That's 425 million to 455 million ounces of theoretical delivery obligation. Let that sink in. 103 million ounces registered, 429 million ounces of contracts. Now, in normal markets, this isn't a problem. Historically, only 5 to 20% of futures contracts actually stand for physical delivery. Most traders roll their positions forward to the next month or close them out for cash settlement. But what we're seeing in 2026 is not normal market behavior. Let me show you the evidence from multiple sources, and you can draw your own conclusions. According to COMEX delivery reports, January 2026 saw 49.4 million ounces delivered. For context, January 2025 saw approximately 5 million ounces. January 2024 saw approximately 3 million ounces. January 2023 saw approximately 2 million ounces. January is classified as a minor delivery month, traditionally one of the slowest periods for physical settlement. The January 2026 number represents a 7 to 10-fold increase over historical norms. Why would this happen? The most straightforward explanation is that market participants are front-running the March delivery period. They're accelerating their delivery requests, taking physical possession now rather than waiting. As of early February, delivery data shows approximately 2,765 contracts delivered. That's 13.8 million ounces in just the first few days of the month. Nearly 100% of open interest in the February contract stood for delivery, far beyond the typical 5 to 20% rate. This is not futures trading behavior. This is physical metal acquisition. Zoom out further. Total COMEX silver deliveries for all of 2025 were 474.4 million ounces. That's more than double the 202.7 million ounces delivered in 2024. Every single month in 2025 showed higher year-over-year delivery demand. The trend is clear and accelerating. This isn't just happening on COMEX. Look at the international data. Shanghai Futures Exchange silver inventories have fallen to their lowest levels since 2016, according to exchange reports. The premium of Shanghai silver over COMEX silver widened to $3 to $5 per ounce in late January, a clear arbitrage breakdown signaling regional supply stress. China designated silver as a strategic material in 2025 and implemented export restrictions. This has fragmented the global market, making it harder for Western exchanges to source metal from traditional suppliers. Silver lease rates. The cost to borrow silver for short periods typically run around 0.3 to 0.5% in normal markets. By January 2026, one-month lease rates spiked to approximately 8%, according to Japan Bullion Market Association data. Think about that. Someone is willing to pay 8% annualized just to borrow silver. That only happens when physical metal is genuinely scarce and time-sensitive delivery requirements are forcing desperate measures. Reports from manufacturing sectors show unprecedented direct purchasing. Samsung C&T, through a subsidiary, signed a prepayment agreement with Silverstorm Mining in late 2025 to secure 100% of the output from the La Paria mine in Mexico for 2 years. They're not buying from COMEX. They're not trading futures. They're locking up mine production directly because they cannot rely on the futures market for dependable supply. The pattern is consistent across data sources. Physical silver is being demanded at rates far exceeding the normal behavior of a functioning futures market. Now let's talk about March specifically and what the math actually looks like. March delivery begins on February 27th with, quote, first notice day. That's when contract holders can start issuing delivery notices. The delivery period runs through the end of March. Current registered inventory is approximately 103 to 113 million ounces. Let's use 108 million as a midpoint. March contract open interest is approximately 85,000 to 91,000 contracts. Let's use 88,000 as a midpoint, representing 440 million ounces. In the first scenario, if we see a normal historical delivery rate of 10 to 15%, then if 10% of open interest stands for delivery, 44 million ounces are needed. If 15% stands for delivery, 66 million ounces are needed. In this scenario, COMEX has sufficient registered inventory. The exchange would deliver the metal, inventory would decline but remain functional, and the system would continue operating normally. In the second scenario, an elevated but manageable delivery rate of 20 to 25%. If 20% stands for delivery, 88 million ounces are needed. If 25% stands for delivery, 110 million ounces are needed. This would nearly exhaust current registered inventory. But there are mechanisms. Eligible silver can be converted to registered if owners choose to do so. The question becomes, at what price? If silver trades at $82, owners might not convert. But at $95, $105, $120, higher prices incentivize conversion. The market has a way of solving this through price discovery. In the third scenario, a crisis delivery rate of 30 to 40%, if 30% stands for delivery, 132 million ounces are needed. If 40% stands for delivery, 176 million ounces are needed. This exceeds current registered inventory even if we assume significant eligible to registered conversion. At this point, COMEX would need to either see massive price increases to incentivize conversion of eligible stock, implement emergency measures like extended delivery timeframes, allow or force cash settlements at market prices, or experience a delivery delay or partial default. Historical precedent shows us that December 2025 saw 46.635 million ounces delivered, representing approximately 50% of estimated free float registered inventory at that time. Given that January 2026 delivered 49.4 million in a minor month, and February is tracking towards similar levels, a 20 to 30% delivery rate for March is not unreasonable to expect. Let's project forward. If registered inventory continues draining at the current pace of approximately 785,000 ounces per day, then by February 27th, first notice day, approximately 96 million ounces will remain. By mid-March, approximately 85 to 90 million ounces will remain. By the end of March, approximately 75 to 80 million ounces will remain. These are estimates, but they're based on current observable trends. Stop for a second and think about this. The math is tight, very tight. It doesn't mean COMEX will definitely default, but it does mean the physical delivery pressure is real, measurable, and creating conditions we haven't seen since the Hunt Brothers era in 1980. As we head toward March 27th, there are three types of people in this market. The first type is the scared. You saw silver hit $121, watched it crash to $76, and now you're wondering if you should sell. You're worried about another crash. You're reading headlines about margin calls and thinking the whole thing was just speculation. If this is you, here's what you need to understand. The price volatility is real. Silver is the most volatile major commodity. The January crash was driven by legitimate factors: Fed policy expectations, margin requirement increases, algorithmic selling. But the physical fundamentals haven't changed. Industrial demand for solar panels, electric vehicles, and electronics continues growing. Mine supply is constrained by declining ore grades and long development timelines. The paper market experienced a repricing event, but the physical shortage didn't disappear. Ask yourself, why are lease rates still elevated? Why did January deliveries set records? Why are major manufacturers signing direct mine deals? The second type is the confused. You're watching the price action and can't make sense of it. How can silver crash 33% in one day if there's a shortage? If COMEX is running out of metal, why isn't the price at $200? Here's the explanation. You're watching two different markets operate on two different timelines. The futures market is dominated by leverage, algorithms, and short-term positioning. When margins get raised and positions get forced out, prices can move violently in either direction, regardless of physical fundamentals. This is mechanical selling, not fundamental selling. The physical market moves more slowly, but more decisively. Mine deals take months to negotiate. Industrial procurement happens on quarterly cycles. Physical deliveries take weeks to settle. The price you see on your screen is the futures price. It's discovering the intersection of paper supply and demand in real time. But the physical market is sending different signals through delivery data, lease rates, and premiums. Eventually, these two markets have to reconcile. The question is how and when. The third type is the strategic thinkers. You understand that March is a stress test. You're watching the data, not just the price. You recognize that whether COMEX delivers smoothly or faces challenges, the structural setup has changed. If you're in this group, you're probably asking the right questions. What happens to May and July contracts if March exhausts significant inventory? How do elevated lease rates affect the cost structure of the entire futures market? What does it mean when major industrial users bypass exchanges entirely? The answers point to a market undergoing structural transformation. Regardless of March's outcome, the fractional reserve nature of commodity futures is becoming more visible and more strained. I can't give you financial advice, I'm not your advisor, and everyone's situation is different. But I can tell you what the data suggests. If you own physical silver, understand that short-term price volatility is separate from long-term supply fundamentals. Paper markets can crash. Physical metal continues to get delivered, month after month. If you're considering buying, understand the risk profile. Silver can move 10 to 20% in a single session, but the same fundamentals that drove it to $121 are still present. Supply deficits, industrial demand growth, geopolitical fragmentation of supply chains. If you're staying on the sidelines, that's completely valid. Watch March closely. The delivery data will tell the story more accurately than the price action. Here's what we know with high confidence. COMEX registered silver has declined 38% since October 2025 and continues draining at measurable rates. Delivery demand in 2025 more than doubled year over year, and 2026 has started even stronger. March 2026 has the highest open interest in recent years, heading into a major delivery month with one of the lowest registered inventories. Global physical markets show signs of stress through elevated lease rates, regional price disconnects, and direct sourcing strategies by major industrial users. The January price crash was mechanically driven, but did not resolve the underlying supply-demand imbalance. What happens next? The most likely scenario is that COMEX navigates March through some combination of higher prices, incentivizing eligible to registered conversions, lower than feared delivery percentages as some longs roll forward, potential use of cash settlement mechanisms for some contracts, and continued inventory decline, but not complete exhaustion. The least likely scenario is that nothing changes and everything returns to, quote, normal. The possible scenario that would create the most disruption is that delivery requests exceed available inventory, forcing extended settlement times or emergency measures. This would damage confidence in the paper market's ability to deliver physical metal. Here's the timeline to watch. February 27th is first notice day for March contracts. Watch how many delivery notices get issued in the first few days. Early March is the peak delivery period. Daily warehouse reports will show the rate of inventory decline. Mid-March is when, if registered inventory drops below 70 to 80 million ounces while deliveries continue, stress indicators would become more acute. Late March is final settlement. The total delivered amount will tell us definitively whether this was a normal delivery month or a historic stress event. My prediction, based on current data, is that March will likely see 60 to 90 million ounces delivered, significantly higher than historical major month averages, but manageable with price increases and some eligible conversion. This will leave COMEX functional, but with critically low registered inventory heading into May. The real crisis, if it comes, might not be March. It might be the cumulative effect of March, May, and July all drawing down a shrinking pool of registered metal while industrial demand continues accelerating. The silver market is telling us something. Multiple data points from multiple sources all point in the same direction. Whether that resolves through higher prices, structural changes to the futures market, or some form of delivery stress remains to be seen. Don't just watch the price, watch the delivery data, watch the inventory reports, watch what industrial users are doing. The paper price can be volatile, manipulated, and disconnected from reality for extended periods, but physical metal doesn't lie. You can't deliver ounces that don't exist. March 27th starts in 16 days. I'll be tracking this closely and providing updates as the data comes in. Subscribe to this channel for regular updates on the COMEX delivery situation. Turn on notifications. This is a developing story. In the comments, let me know. What do you think happens in March? Are you positioned for this or watching from the sidelines? What questions do you have? And if you found this analysis valuable, share it with someone who needs to understand what's actually happening in the silver market right now. The data is available to anyone willing to look. The conclusions require you to think for yourself. We'll see what March brings. Thanks for watching, and I'll see you in the next update.